disproportionately women do that. Women CEOs don't pay ourselves while we're taking care of everyone else around us. And the experience that I had, actually, my husband's also founder. And so we were moving during COVID, and because I hadn't paid myself, I've actually never shared this, because I hadn't paid myself for 4 years, I couldn't get a mortgage. We were moving out of San Francisco, and I was moving to be next to my niece Evie and my mom, and I couldn't get a loan. And I had to call my board and have a conversation about, wow, I am out of alignment with my own values. While I'm living the mission of Candidly to help crush debt and build wealth, oops, I forgot to do that for myself. And there are real implications and consequences for that decision.
Hi everyone, I'm Maggie McGrath, Senior Editor at Forbes. There is approximately $1.8 trillion in outstanding student loan debt in the United States. It affects more than 40 million Americans. And joining us now is a founder and CEO who is trying to help these people, and she's navigating a really complex political environment as she does so. She is Laurel Taylor, the founder and CEO of Candidly. Laurel, thank you so much for being here.
Thank you for having me, Maggie.
So you founded Candidly after your own experience with student loan debt. Can you give us a 90-second overview of Candidly's origin story?
I had a tremendous amount of student debt. So I grew up in a household like 70% of Americans today knew I was going to college, knew how I was going to college, and that was through accessing scholarships, grants, federal loans, private loans. What I didn't know is that between my mom and I, we would miss out on 2 decades of compounding interest on wealth while paying down debt. And my alma mater, MIT Age Lab and TIAA, now one of our partners, indicated we are not special. That's what 80% of those with student debt do. They first spend all of their income to pay down student debt while foregoing savings and retirement savings. Unfortunately, missing out on the first 10 years and the last 10 years of compounding interest on wealth is pretty financially devastating.
And you had debt at a 9% interest rate as well. That's a high interest rate. So you're not only missing out on tremendous growth, but you're spending a lot of money just to repay those loans.
That's right. And it's the average borrower, the average American today takes 17 to 20 years to pay down their student loans. And we see populations that now are taking 24 to 29 years to pay down their student loans. And so one of the messages that I think is so important to understand for those who are privileged to not have student loans is that student debt is mom debt. It's dad debt, it's spousal debt, it's grandparent debt, it's everyone's debt across all ages and wages. And it is the second largest life expense, second only to mortgages. And so as we think about going beyond student debt and into savings and retirement savings, really normalizing that most of us begin our journey with financial services on the liability side of the balance sheet, not the asset side of the balance sheet.
That's my own experience to a T. What is Candidly, and what are you trying to accomplish with this company?
We exist to crush student debt and enable hardworking Americans to go beyond student debt into savings and retirement savings via simultaneous progress versus sequential. And we are achieving that objective as a workplace benefit. So we are offered by employers to their employees to help address the number one concern within the workplace today. And at the time that I founded Candidly, it was a very novel idea which to me is incredibly obvious coming from, I led a global business unit for Google. Previously, my entire career has been in technology. So I'm new to the financial services landscape. What was very obvious to me, of course, we need a digital experience to help address the most complicated, more complicated on a daily basis aspect of financial services where we're beginning our journey, arguably with the least amount of financial literacy, 18 to 22. And the big bet in creating what was once novel and is now firmly a new category into the new normal, I believed that major positive policy levers would be pulled that would enable employers to address student debt within the workplace right alongside their 401k plan, right alongside their tuition reimbursement program to help employees in their financial wealth and wellness journey. And those policy levers were pulled in 2020 and 2022. And so now we're moving from this new category into new normal in terms of adoption and access that employees and workers have to Candidly.
We'll get into the policy weeds in just a second, but let's go through an anecdote, a hypothetical anecdote of a Candidly user. So let's say I'm an employee at UBS, which offers Candidly as an employee benefit. I'm Maggie. I graduated with $65,000 of student debt. I feel like I have no ability to save for retirement. I go to HR, they tell me about Candidly. What happens next?
Yes. First, we meet you with empathy. So there's a lot of shame that most individuals have that have student debt. Parents who wish that their kids were not graduating with student debt. Those, I don't know how you felt, but when I graduated with student debt, I also felt like nobody else, like no one was talking about it. And so there was this whole feeling, around this whole kind of energy around it that was just, and we hear it from those that we serve. So when you hear about Candidly as an employee, you likely hear from a couple of different channels, from HR, but also through our outreach, to really celebrate that your employer is offering the first benefit ever designed to meet you where you are today and enable you to move beyond this barrier to every other wealth accumulating event. So what we're hearing from borrowers right now, the four sentiments are fear, worry, dread, and confusion. So employees coming into our platform today are saying, I do not know what is going on. And just as you shared, $65,000 feels like a tremendous amount. And so what we're hearing is 57% of those we serve do not know who their servicer is. 46% do not know how much they owe. We have prime and super prime, so those who are super engaged in their financial services and financial wellness more broadly, coming into the platform looking for, number one, guidance. Help me understand where I am. Help me understand the status of my loan, because I may have been put into administrative forbearance or forbearance, because federal programs have been coming on and off the shelf on almost a daily basis, right? So how much do I owe? What's the status? And then help me lower my monthly payment. Help me access these incredible federal programs that are available, but I just don't know how to get into. So the average borrower that comes into our platform, we're helping them save $358 per month in less than 6 minutes by making it an elegant and easy experience to understand for you what are the available options that you can take advantage of and leave the experience with the problem solved.
And so that's the education part of it. Is there an employee match? Is there, if I am paying $600 a month, is, in this example, UBS giving me a 1% match instead of a 401k 1% match, or how does that part work?
Incredible. So there are two different major pieces of policy that passed. One was called the CARES Act, which enabled employers to offer $5,250 annually, tax-free, to help employees pay down their student debt. Now, in this program design, and the greatest usage of employer contributions to help pay down student debt is in healthcare, education, and technology segments of the workforce. And so that actually enables employees to pay their debt down faster. Now, what employers are seeing when they use what's called their Section 127 budget, they're able to tap into their tuition reimbursement budget for past, present, or future education. So the same budget for skilling and reskilling can now be applied to address the debt workers are bringing into the workplace. We have facilitated over $100 million in employer contributions to date. It shaves off about 6 to 7 years of their repayment journey. And again, it's tax-free for both parties. That just went into permanent extension. Just so exciting because employers were saying, we don't know if this is going to be temporary, it's set to sunset at the end of the year. But now actually one of the really positive attributes of the One Big Beautiful Bill, which I know we'll get into, is permanent extension. So there is a recognition that employers want to help their employees pay down their student debt because they get return. There's a 76% reduction in turnover across employees receiving that contribution. The second piece of what you just asked is actually a very different program design. With Secure 2.0, there's this tiny little provision within Secure 2.0 of over 90 provisions that helps employers offer a retirement match to employees who are paying down their student debt and foregoing that retirement match. So the retirement match is available, but most employees, as we talked about with the MIT Age Lab, really are prioritizing being debt-free first. Or they can't actually afford to have any money taken out of payroll for a future state because and today they have to pay their student loans. So that's where we're seeing employers offer a retirement match. It actually goes into the retirement savings plan while employees pay down their debt. And that's that simultaneous progress that we were talking about. And what we're seeing is durably now, we're bringing 13% of net new employees into retirement savings. First time savers. They're saying, yeah, I got to pay down my debt, but now I get an upside and you're helping me build wealth. And then we're seeing 27% who are already saving in retirement savings, but not able to maximize that employer match because of their student loan payments. 27%, there's a lift in 27% of those now able to maximize the match.
I could have used that because I definitely remember getting enrolled in the 401k and they wanted to auto enroll me at a certain percent and I bumped it down a few percentage points because I needed that cash flow to pay down my student loans. So these are two pieces of legislation that have been tailwinds for your business. We're sitting in an environment right now where there have been a few headwinds. Candidly processed a record number of applications to public service loan forgiveness, that program. But the Trump administration is looking to make changes to this program. How is that affecting your business right now?
So the primary effect of our business right now is total distress that borrowers are showing up in our platform. We have a 460% increase in the utilization of our platform. We're seeing a 280% increase in use of our coaches. So there's a high tech and then a human touch component. So we're seeing this surge of utilization of our benefit. Number one, because we are coming off a period of 4.5 years where 43 million Americans actually did not have to pay their student loans. They could push pause, they could hope for forgiveness. And what we're seeing is for 4.5 years, non-repayment was met with no consequence, right? It was an opportunity to take a breath, hopefully save, and accumulate a nest egg. And now non-repayment means credit scores dropping by 170 points. And individuals waking up in the morning realizing they've had a 170-point drop in their credit score. So I think what's really important as we talk about public service loan forgiveness is to appreciate we're at the highest default rate in the history of the portfolio. We're currently, TransUnion just shared a data point, we're at 31% delinquency and default. That includes prime and super prime. So that's really a symptom of something seriously wrong, seriously broken. If those who are fully engaged cannot figure out how to manage this part of their life. So from a public service loan forgiveness perspective, I think it's important to share there's been so much controversy around forgiveness. The public service loan forgiveness program was introduced in 2007 bipartisan, and it was designed to bring public service workers into our economy to fill mission critical jobs. So when we think about our parents in the hospital, and as we think about children, and we think about pediatric ICU, and we think the school system and teachers, my mom was a social worker, firefighters, police officers, mission critical roles where individuals are sacrificing, and they're saying, this is a calling. It's my calling to be a physician. I'm going to go into public service. I'm going to make below market. But after 10 years of really diligent payments, 120 of them, my outstanding balance will be forgiven. And the negotiated rulemaking process around public service loan forgiveness is designed to ensure that public service loan forgiveness that is available for employers who are offering what this administration is defining as public service.
And that brings up a question, because when Trump initially announced these changes, he said that the public service loan forgiveness program had, quote, misdirected tax dollars into activist organizations, end quote, that he went on to kind of describe that harm national security. So what does this mean for folks who, you mentioned those 120 payments, so that's 10 years of repayment. There are people who chose to enter this program 10 years ago, 10 years before the 2024 election, or 8 years before. Have you heard from any of them, or what chaos and confusion does a statement like that cause to Candidly's users?
The chaos and confusion is definitely at an all-time high. We're coming off of, again, multiple years of daily headlines, daily changes, federal programs, on and off the shelf program called Save, and income driven and pay in as you earn, and repay, and all of these different programs. So we're just here, there's just a lot of fear. There's a lot of fear and distress around, are these programs going to be available? Am I going to be able to continue to access them? And so our job to be done is to help employees who we see 77% increase in confidence after having a conversation with a coach. Our PSLF program, which is automated, we came up on the first anniversary, less than 2% were actually approved. In user error on the employee side, on the employer side, the paperwork was filled in incorrectly. So our job is to ensure that every American worker who has access to PSLF, the PSLF program, gets into and takes advantage of that program. And what we see is when we deploy the PSLF program through Candidly, there's a 5x increase in utilization and throughput. Despite having access to PSLF, the average employee, their first-time applicants, even after they've worked for their employer for almost 7 years, so they're applying for the first time, they're at an average of 58,000 plus that will be forgiven 3.5 years from that point in time, didn't know about the program, couldn't figure out how to get into it, couldn't figure out who the employer signatory was. And so it's a really obvious application of technology and digital and data science to automate that process and ensure that those who are working for institutions that qualify can access it. So that's our primary job to be done, is to ensure that as a technology company, last week we talked about in the negotiated rulemaking process, there are 1.5 million employers that are PSLF eligible institutions. They cover 12.8 million workers. That's just on the private sector, excluding federal, state, governmental workers. That's a huge, there are like 2,000 employers taking advantage of the PSLF program. So it's a real converging crises, communication, operational, technology, and the private sector really being able to evangelize and make these programs accessible.
You mentioned the rulemaking. You were in DC last week and you posted, I want to read something that you posted online about your experience in DC. You said, quote, "While we rigorously debate policy, real people are defaulting at record rates, including prime and super prime borrowers who never imagined they'd be here. Each new administration adds more programs, more complexity, more bureaucratic maze for desperate families to navigate. The most respectful interpretation, the policy is designed to help without the ability to operationalize and automate, and so it hurts instead. Those are powerful words. How were they received on Capitol Hill?
I think it depends on the audience. And I think it's important to share that I saw the department work really hard for 3 days to come to consensus. There were a number of concerns that were presented that they earnestly, genuinely responded to in the language that ultimately emerged from 3 days together. My biggest concern, the whole thing is just a disaster. It's an absolute mess. Each administration has a different point of view on education financing, how families access federal funding, how much federal funding should be available. Since it was introduced from the GI Bill, different programs and income-driven repayment programs. Americans are just trying to live their lives, right? They're looking for a way up and out. They are believing in the promise of education to increase lifetime earnings. There is a slog at the other end of that with complexity brings devastating outcomes. That 170-point drop in credit score is equivalent to bankruptcy. And for those who are not in repayment, there will be wage garnishment in the private sector. So also for all of your business leaders that are listening in today, in the fall, the private sector will receive a letter from the IRS requiring finance and HR to garnish the wages of employees who are not in repayment. And that can be around 15% of wages. Employers don't want to be in the business of wage garnishment of federal student loans. So the most important thing for us to do together as a community and as an ecosystem is to proactively mitigate and minimize those that are falling into default. And that is through making these programs that are available that no one knows about, can't figure out how to get into them, because it is pre-Facebook technology. I mean, it's pre-Facebook tech. We're talking about phone calls and fax machines. Employees are on hold for several hours trying to get a hold of their servicer and modernizing it just like any other area of our financial services experience today.
So you are running a tech company ultimately, but we've been talking about policy. You were in DC. So as a CEO founder, you sit in an interesting seat. How do you think about strategizing your time and dividing your time between the policy conversations and advocacy and explaining versus the regular operational, financial, strategic duties that fall on a CEO on a day-to-day basis?
I am always looking for mentorship on time management. I'll start with that. So it was an honor to be able to participate last week, to bring an operator's perspective, to bring a technology perspective on no matter what emerges from one administration to the next, we need to make it as easy as possible for American families of, again, all different ages and wages to figure out the way into wellness and wealth. And as the founder and CEO, because policy has such important implication to the end user that we serve, it's all about impact. It's all about outcomes. It's all about the relief and financial relief, which is an intangible that is difficult to measure. We measure the $2 billion in impact. We measure the first-time wealth that we're creating in partnership with employers. But the intangible is that feeling of freedom and relief. I got a plan, I got a strategy, I know what I'm doing and I know how to do this. That is the heartbeat of the company. And so the focus is on the heartbeat of the company, which is how do we enable hardworking Americans to go from the liability side of the balance sheet to the asset side of the balance sheet? And how do we mobilize and move mountains and the market together to bring Secure 2.0, which was passed in 2022, that just became available on January 1st of 2024, how do we ensure that every American worker has access to that retirement match while they pay down their debt? Because we know in the data that they'll have an average of $450,000 at the time of retirement savings if they just get a match on their student loan payments for half of the time that they're paying down their debt, and even if they never put a dime into retirement savings themselves. That's 4 times what boomers have today. That one little provision. So we are irrational, we are unreasonable, and Willis Towers Watson indicated 42% of employers would offer the Secure 2.0 student loan retirement match by the end of next year. We want it to be 100%, and we want it to be 100% of the market offering the retirement match, which is about 46% of employers, as soon as possible, because those are individuals who have their first 5 years in the workplace, where compound interest work, its greatest magic. The last 5 years before they retire, the urgency to get out and move the market together. That's really, so my time is like 90% on how do we move the market, working with employers, working with partners that distribute our offering like Vanguard, Empower, Schwab, TIAA, Bank of America, Merrill Lynch, Guild. Like, we go get after it together with urgency. And that's the thing I think is missing the most, is the urgency on, making this accessible as soon as possible.
That urgency is hard to understand unless you've had student debt, in my experience. I paid my loans off a few years ago, and I remember it was a huge accomplishment.
Yes.
And I remember how I felt in my early 20s, and it just felt like a monthly emergency every time I saw those balances, because I signed up for auto pay, come out of my accounts, and I just wanted to pay down the debt faster. But that's an experience that's very particular to a borrower, and unless you've had that, which you have as well, I think it's hard to feel that urgency. Do you experience that in talking to folks who have no experience with student loan debt?
Absolutely. I can feel it. I can actually feel it in the first few minutes of interacting with someone, because I'm trying to figure out how to inspire them. How do I inspire the decision maker who's in the seat and who has the power to affect their whole employee population? Our average employer today serves about 22,500 employees. And the unlock of appreciating one of the employers we work with, Pearson, we conducted a retirement plan assessment, and then we pulled what we call a Candidly impact assessment to help them understand what percentage of employees have access to the retirement match, but are foregoing it. What percentage of employees are participating but not maximizing. And she saw her own data, Stacy at Pearson, and said, I can't unsee what I've seen. It's women, it's a younger population. Those under the age of 30 leave 46% of the retirement match on the population. It's their diverse population, and she made the decision. I want to be a part of that. I want to help serve this population and bring them into the program. And it's great for the business, because it's a double bottom line impact of retention, acquisition and retention. We're seeing a reduction in turnover north of 50% by those who have access to that retirement match on their student loan payments. But as I'm trying to understand how to move the person that's the decision maker, if it's a finance conversation, then it's about the return on investment of the acquisition and retention in the data. If it's someone that's lived the story, it's really both, but it is a bit more heart, but sometimes that can turn off the audit. So we're always trying to, as change agents, as pioneers of a new normal in the market that we know has massive impact, is understanding what matters to the impact and outcome that person in power is looking to achieve.
I think that's probably advice for anyone running a mission-oriented business. Now, you mentioned your average employer serves a little over 22,000 employees. How do you go from person with student loan debt to founder of a company serving, you named some of the biggest names in finance? Was there one inflection point?
I think that There are so many inflection points that just happen almost on a daily basis. It's the first customer who said yes. That was a small, medium business. And then it was the first mid-market employer. And then it was the first enterprise employer, which was Fiserv and Salesforce. And then serving the enterprise employer and showing the impact across their employee population and the return, we earned the right at the same time as nailing vendor risk and information security requirements of the largest financial services companies in the world. We earn the right to serve the machinery that moves the market, that has descended on the market and is automating the 401k and 403b and automating tuition reimbursement and integrating into their offering so they provide a holistic experience that addresses the full spectrum of wellness within the workplace. And so it's the momentum. It's the first down, the second down, the third down, and that momentum over now 9 years as the clear category leader that wins every opportunity that we pursue. And so the challenge that we're trying to solve is, how do we win more opportunities? How do we get in front of more decision makers to serve more employees? So I don't think there was a single inflection point other than the daily inflection point of just keep going. You gotta keep going because it's like a marathon it feels like a hit. It's like a hit run, but over a marathon course as we're fast twitching all of the different, it's been a very volatile 5 years.
That it has. And as a founder growing a business, you have to also think about the team that you are hiring. How do you think about hiring your executive team? Because it's hard sometimes to delegate. So what do you as founder CEO look for in your C-suite?
Integrity. Integrity is number one. Player coach. So I have an expression, we all sweep the floors. We do whatever needs to be done, and we do it with humility and with our core values of empathy for the other person. What's the job to be done for our colleague? With humility, the best ideas come from those closest to the work. With MacGyverism, we're always problem solving crazy problems as just part of the day job. And collaboration, a real bias to action and collaborate. So the culture of the company is a real roll your sleeves up, work alongside one another. My goal is to be the place where we can do the best work of our lives. That is an incredibly ambitious goal. And that is also the point, which is, how do we be together the place where we can do the best work of our lives? What does that look like? What does that feel like? And it's kind, and it's urgent, and it's interactive, and it's multidisciplinary and diverse. And so from management to ELT to an intern, I am looking for that problem-solving, creativity, high integrity, mission first. Because the mission, I look at the team and the number of changes in our product that we've had to make almost on a daily basis to respond to new programs, changing calculations, that could be quite fatiguing for a lot of people. And our team they show up, they want to get it done because they know the alternative is a system of incumbents who will be able to respond to that 3 to 4 years from now. And that's part of the 31% default that we have to solve right now. So that mission is, it's so humbling to see the level of heart and grit and super high EQ, IQ that the team brings to the organization.
You are mission-oriented. Candidly is a mission-oriented business. You just mentioned that in what you look for. But I'm wondering, as you're hiring, if someone is an excellent technician or has excellent EQ, IQ, all these other things, but they're just not passionate about student loans, but they want to work for you. Is that someone that you hire, or do you really need that mission-oriented person on your team?
You got to have it all. So they don't have to have had personal experience with student debt, but there has to be emotional connection and resonance with the mission of the work that we're doing, because ultimately that empathy expresses as creativity. And we are really excited. Can I tell you about our upcoming release?
Of course.
So we are releasing our conversational AI tool. We call her Kate, conversational AI tool. And Kate is a direct response to the desperate need for a deeply personalized experience that has inputs into the system that are changing on a near daily basis. And so when we look at that, it's just fascinating. When we look at the data of utilization of ChatGPT, right? It took 10 years for the internet to get to 100 million users. It took 2.5 years for Instagram to get to 100 million users. It took 2 months for ChatGPT to get to 100 million users. And then we look at the data of how it's being used. 74% for anxiety. 74% of consumers go to ChatGPT looking for advice on anxiety. Over 67% on financial advice, and over 50% on investment advice. Now, the financial services landscape would scoff at that, or medical professionals as well. It may not be appropriate, but there's really interesting signal there of, at scale, individuals showing up and interacting with an experience that feels judgment-free. Math, not great, right? LLM is not great at math, but really rich in empathy. And so because it's such a dynamic space, as a technology company, we always work with the best technologies to help employees and American workers and individuals make simultaneous progress. So individuals show up to solve problems, but the industry is organized around product. Mm-hmm. So an employer may offer 50 different benefits, and those benefits may be provided across 200 different providers. So what that means for us as we go into experience, 50 different front doors that are all optimizing for one particular problem, but that's not how we solve problems. So individuals are able to come into Kate, our conversational AI tool, and through a contextual, natural experience, problem solve and help that individual understand what their best options are, take action on that, leave with a transaction. Oh, my employer is offering a retirement match. Well, should I go into this income-driven repayment program and pay less to my student debt so I can actually also top off? And because we are a technology company that's been working on this problem for over 9 years, we have the ability to also understand what has to be true for the employer, what has to be true for the largest financial services companies in the world, which is the math has to be perfect and precise every time. So in the back end, Kate is this very simple, beautiful interface. It's multimodal, responds to the user based on the language, sophistication, problem they're trying to solve. But on the back end, there's a horizontally extensible platform that's deeply configured to the partner and to the employer that has the ability to span. So let's imagine a 401k provider. They have a wellness, they have a retail, and they have an advisory services offering. And they want their customer who shows up in the workplace to be able to move between their workplace, their retail, and their advisory services. That could look like 3 different users, 3 different experiences. So our platform strategy integrates all of that into one back-end platform with tools and functions being called, so the math is always precise and perfect. So we can give specific, if Maggie comes in and you have $65,000 in student debt and your employer's offering is 6%, but you're also just had children, so you're thinking about how to save for the future to not repeat the cycle, that's a highly complex consideration set, and we're gonna bring the full power of the partner to bear in that discussion, so you know all of your available options, and not just learn about it, but actually do it and transact and finish that experience with a plan that also can change as you change. So it's not just a student debt conversational AI tool, it's actually a full financial assistant.
I was about to say, that sounds like a CPA or a financial advisor.
Exactly. So we're democratizing access. What we've learned from our users who show up and on average save over $18,000 one coaching session with a coach. which like almost doesn't sound real. No, those are heavily public service loan forgiveness oriented coaching sessions. This is someone who works for a hospital, who works for a school system, didn't know how to get in the program, didn't know how to get into an income-driven repayment program. We kept hearing, I have no financial advisor. This is the only financial advice I've been given. The relief. And so when we thought about that, we thought, okay, well, the industry is optimizing the asset side of the balance sheet in the 1%. The 99% who don't have access to a financial advisor. And the financial advisor and advisory space actually is a critical knowledge gap in how to prepare and plan for college, how to then pay and send your kids to college, and then that repayment journey. It's super weird that that's outside of the consideration set because it affects 1 in 2 American households. So we are going to solve that problem. We are solving that problem, and we are going to bring candid, authentic conversation to the #1 consideration set for American households beyond a mortgage. I mean, student debt has overtaken medical debt, credit card debt, and it's really thrilling to be a builder and an operator at the time of AI and deploy that technology to, our goal is in 8 years to have generated $800 billion in first-time wealth while crushing student debt.
And first-time wealth.
Yes.
I have a related question.
Yes.
As founder CEO, I've heard you say that one of the mistakes that you made early on was not paying yourself. So for other founder CEOs who might be watching this, what is your recommendation? How do you do that math? How do you have those conversations with your board? How do you pay yourself?
I've made a lot of mistakes. I will start with that. It's a very humbling journey to be a first-time founder and CEO, and it's something that I just started talking about, the mistake I made of not paying myself about a year ago, because disproportionately women do that. Women CEOs don't pay ourselves while we're taking care of everyone else around us. And the experience that I had, actually, my husband's also founder. And so we were moving during COVID, and because I hadn't paid myself, I've actually never shared this, because I hadn't paid myself for 4 years, I couldn't get a mortgage. We were moving out of San Francisco, and I was moving to be next to my niece Evie and my mom, and I couldn't get a loan. And I had to call my board and have a conversation about, wow, I am out of alignment with my own values. While I'm living the mission of Candidly to help crush debt and build wealth, oops, I forgot to do that for myself. And there are real implications and consequences for that decision. And fortunately, my board was incredibly gracious and helped me evidence what I needed to evidence, which was legitimate and true, in order to actually close on that mortgage, to be by my niece. And my sister had passed away, so it was very important to me to be able to physically be by her. But it was a real life lesson in, we have to take care of ourselves. In all the ways. And it's tough because the journey is hard and it's long, and it's definitely not linear. But yes, we gotta pay ourselves and ensure that we have durability and stamina over time.
So Laurel, we have covered a ton of ground, and I'm going to have to let you go soon. But before I do, you've talked about how broken the student loan system is in America. So if someone were to make you president for the day or play God with the student loan system, and you could start it from scratch, how would you build it? What would you do?
Well, first, I would work to put me out of a job. Because the reasons we exist is because of the complexity of how families fund education and how they pay down debt. So if there was no need to fund, if individual families did not have to fund their education journey, what would be ideal, and I think we will see more, we need different and more diverse pathways into the workplace. 4-year university plus is not the right path for everyone, and it will increasingly be more difficult to access in the future for middle class and lower income individuals because of caps that have been placed on access to federal funding. So while we're seeing that there will be a private market that will emerge to help families, ultimately we would have pathways into the workplace. I really admire the program in Switzerland, actually. They have an apprenticeship program. And so I had an opportunity to attend a young leaders experience in Switzerland, and I saw 14-year-olds walking the hallway of various employers. And so providing that experience and welcoming individuals of all backgrounds into the workplace to begin to learn the skills of interacting and presenting and building and creating. And we really need skills into the workplace today through the advent of AI and reskilling and skilling, which we're all moving through. I see a huge opportunity, need, and demand for pathways into today's workplace, whether that's technology or healthcare or education, as well as trades. I think there's a great opportunity for trades to emerge, and then the traditional university system as well. But ideally, we wouldn't be saddling individuals with 17 to 20, now 40, because we're seeing parents paying down their own debt and now sending their kids to school as well. It's a 40 to 50 year journey to pay down student debt. So ideally, we would eliminate that and just have a number of different, more personalized pathways into the workplace. And employers would remove their requirement for degrees.
That is quite the vision. In the meantime, if we were to sit down 1 year from today, what would you hope to report to Forbes that Candidly has accomplished in that time?
Yes. All about impact. It's all about outcomes. So we measure impact and outcomes in days and dollars off of debt. So we're at $2 billion in impact today. We certainly expect to double that. And first-time wealth creation. So our vision is dollar for dollar. For every debt we crush, we want to create a dollar in first-time wealth creation, because wealth is not just for the wealthy. It is now for everyone. We have wealth creation opportunities and moments by translating smart policy into practice. So a retirement match on student loan payments, a retirement match on emergency savings, a retirement match on a retirement match. But ideally, a year from now, we would be sitting down and the list would be so long of employers offering a retirement match on student loan payments that, we just couldn't even get to it all, and that it would create, $2 billion plus in impact.
We'll have to have you back to report on your progress. But in the meantime, Laurel, thank you so much for sitting down with Forbes. We really appreciate your time.
Thank you, Maggie.